Hello and welcome to the Tax Update. We'll be covering what was important to accountants and advisors throughout September. This month, we're looking at the expenses relating to tax-free relief payments. Now, we know that there are a series of payments now that have been declared non-assessable, non-exempt. But does this mean that the business will be prevented from claiming a deduction for some of its expenses? We'll also look at why the ATO is targeting Australian residents receiving foreign-sourced income, and also the cases that challenge access to the cash flow boost payments. There's quite a lot of that going on right now. But many of you would have seen the announcements on the phasing out of the COVID-19 payments. For individuals receiving COVID-19 disaster payments, once a state or territory reaches 70% full vaccination, automatic renewal will end and individuals will have to reapply each week that a Commonwealth hotspot remains in place to confirm their eligibility. At 80%, the payment will phase out across 2 weeks. In the first week, it'll reduce to a flat payment of $450 per week for those that have lost 8 hours or more of work, and $100 for those on income support payments. At week 2, the payment will be brought into line with JobSeeker at $320 per week for those that have lost 8 hours or more of work. For business, as each state and territory manages lockdown support differently, the phasing out, of course, will also be different. Much of it is dependent on whether the funding was jointly funded by the Commonwealth. In New South Wales, for example, the jointly funded JobSaver will phase out once vaccination targets are met. At 70%, the payment will reduce from 40% of payroll to 30%, and maximum weekly payments will be reduced by 25%. That is $750 for sole traders and $1,125 for other entities. The cap for large businesses will reduce to $75,000. At 80% vaccination rate, the Commonwealth contribution to JobSaver will end. Now, this is anticipated to occur at the end of October, and the New South Wales Government is expected to announce details of further support to support businesses beyond this period. For other states and territories, grants are being topped up on an as-needs basis. When lockdown ends and borders open, presumably these grants will simply cease. But now across to Michael on the expenses relating to tax-free relief payments. Across to you, Michael.
In recent months, we've seen the government take action to ensure that certain payments made by state governments can be treated as non-assessable, non-exempt income, which basically means that they can be received tax-free by the relevant business entity. We do just need to be careful, though, because not all state government payments relating to COVID are tax-free. We really need to check the situation to check whether a particular payment qualifies for tax-free status or not. More generally, the cash flow boost that many clients would have received last year is given non-assessable, non-exempt treatment as well. Now, the issue that to date hasn't been addressed all that clearly is what do we do with expenses? Because in the tax system, basically the way it works when it comes to deductions is you can claim a deduction for expenses incurred in gaining or producing assessable income. But if you are incurring expenses to gain or produce something that is classified as non-assessable, non-exempt income or exempt income, then you normally can't claim a deduction for those expenses unless there's a specific provision somewhere that gives you that deduction. Now, if you're a business entity and you've received some government support payments that qualify as non-assessable, non-exempt income, it does mean that there's a risk that you will lose out on some deductions if you have expenses that relate to gaining or producing that income that's effectively tax-free. Well, the ATO has now provided some specific guidance in this area. And basically what the ATO says is that if you're a business entity and you've incurred expenses that relate directly and solely to receiving a payment that is non-assessable, non-exempt income, then that expense won't typically be deductible. So for example, if you're a business entity and you've paid a fee to your accountant to help you lodge an application to receive a grant that is basically tax-free, then you won't be able to claim a deduction for those accounting fees. Now, in some cases, the fee that is charged by, say, an accountant might include work that's been done in a few different areas. In that case, we do need to determine the extent to which that expense relates to generating non-assessable, non-exempt income, and that portion of the fee won't be deductible. There's no kind of hard and fast rule in terms of how you go about making that apportionment. The ATO says you just need to use a fair and reasonable basis. It might be that the client should request a breakdown in terms of the time spent or the portion of the fees spent on certain tasks, and that would usually be the sort of information you would use in making that apportionment. Now, the other issue that comes up is, what about general business expenses? For example, under some state government COVID business grant and ongoing payment programs, you need to meet certain requirements in order to be eligible for and receive those payments. Some of those requirements might relate to maintaining headcount and payroll numbers, that sort of thing. Well, the ATO says that if you are incurring normal business expenses of the type of expense that you would typically incur in the ordinary course of business, with or without the availability of those state government support payments, then the fact that you end up receiving something indirectly relating to that doesn't impact on deductibility. So just to give you a quick example, let's say we have a business operating in New South Wales, want to access JobSaver. One of the requirements to do that is that they maintain headcount. And so as a result, that business might be continuing to pay salary and wages to staff. It's not necessarily a strict requirement, but maintaining headcount is, and the amount of the payment is based on certain payroll information. Well, those salary and wages probably would be paid in the ordinary course of business anyway. They're only incidentally related to accessing that JobSaver payment. So you would expect that the salary and wages would continue to be deductible, even though indirectly they do relate somewhat to accessing that JobSaver payment that for some entities will be non-assessable, non-exempt income. So we do need to distinguish between expenses that relate quite directly to accessing those payments and receiving the payments, things like making applications, performing turnover decline calculations, those sorts of things, the fees you would expect to be non-deductible. But where we have general business expenses, the fact that an entity happens to then receive some income that is tax-free, is non-assessable, non-exempt income, should not impact on deductibility. Really something we need to look at on a case-by-case basis, but if you do have clients and you notice that they've received some government payments that end up being tax-free, then we will need to turn our minds to the question of whether there is some level of expenditure that they've incurred that could be non-deductible.
And now across to Matthew on why the ATO is targeting Australian residents receiving foreign-sourced income.
Now, when the ATO issues a taxpayer's alert, together with a fact sheet on the same topic, I tend to start paying attention. That's just the ATO's way of trying to draw attention to something that they've probably seen and are a bit more concerned about. Now, this taxpayer alert basically deals with Australian residents disguising what otherwise would be foreign-sourced assessable income, profits or capital gains as non-taxable gifts or loans. So to illustrate this, one of the examples in the alert deals with a situation where an Australian resident sells their shares that they hold personally in a foreign company. Now, the first issue here is that the Australian resident doesn't actually declare the capital gains in their Australian return, but then also takes the extra step of trying to recharacterise the proceeds as a loan. So basically, the sales proceeds are paid directly by the purchaser to an overseas related party. The overseas related party then tries to repatriate the proceeds back to Australia through what it actually calls a loan. Well, that doesn't actually work. The source of the funds is a capital gain derived by an individual selling shares that they hold personally. So there's actually a capital gain that needs to be dealt with here. Now, the other example worth bringing up in the alert involves a profitable foreign company with an Australian shareholder. Now, instead of declaring assessable dividends, the foreign company loans some funds to an overseas family member who then gifts those funds back to the Australian resident shareholder. Well, the ATO says that doesn't work either. For the Australian shareholder, the ATO either sees an assessable dividend or, if not, a potential deemed dividend under Div 7A. Now, it's just important to be aware that Div 7A is actually quite broad. It can apply to payments or loans made to shareholders from private companies, even if those private companies are foreign. It can also apply if the funds from the company passed through interposed entities. Now, I don't actually think the ATO is trying to say here, ignore the documentation and ignore the evidence. So if you're looking at something that's referred to as a gift, you'd still be asking the question as to whether there's a deed of gift or some other documentation to support this. Rather, I think the ultimate point here is that the ATO is probably flagging that they're going to be looking a bit deeper and will start to question, if they're not already, around where the funds are ultimately coming from. So if the funds are sourced from undeclared offshore capital gains or offshore investment income, then calling those funds a non-taxable gift isn't going to be helpful and could actually be a bit more problematic. On the other hand, if the funds are sourced from a foreign company or a foreign trust, then the ATO is going to be looking at whether there's an Australian taxing point somewhere down the line. So, for example, when it comes to companies, they'd be looking under Div 7A or even the CFC rules. And when it comes to trusts, they'll probably be looking at whether the foreign trust rules in Section 99B could apply. Now, it's also important to remember there is a broader context to all this. In recent years, the ATO, as well as other tax jurisdictions, have actually gotten a lot better at exchanging information with each other. And it is getting beyond the more typical AUSTRAC data matching. So it's actually a good idea to be asking your clients in that year-end process around whether they've received any gifts, loans, and other undeclared payments, and trying to work out how that's all supported.
And finally, those cases from Michael that challenge access to the cash flow boost.
In recent months, we've seen the ATO really step up its compliance activities in relation to the cash flow boost. And in some areas, we've seen examples of where the ATO has looked at quite specific technical details of the cash flow boost program and challenged the availability of payments that entities might have received initially. In other cases, we've seen the ATO look at the integrity rules, and the integrity rules within the cash flow boost system basically say that if some parties have entered into an arrangement, a scheme, in order to obtain or increase the amount of the cash flow boost, then that entity is not entitled to the cash flow boost at all. So even if you would have been entitled to an amount of the cash flow boost, if the integrity rules are triggered because you tried to increase your entitlement, then basically the way the rules work is you miss out completely. Well, we've seen another example of the ATO seeking to apply the integrity rules to cash flow boost payments in the last month. And I suspect this won't be the last one we see. In this particular case, we had a company that paid some directors' fees to a related party towards the end of March 2020. And the timing of this is pretty important because that director's fee was paid shortly after the cash flow boost program was announced by the government and shortly after the ATO had released some guidance explaining how the cash flow boost program would operate. Now, in this case, the ATO had initially actually gone after the taxpayer, arguing that these directors' fees were never actually paid, and as a result, the entitlement wasn't there. Well, what ended up happening was that the ATO then kind of looked at this from a different angle and actually tried to argue that the integrity rules were triggered. The ATO said that these directors' fees were paid and were part of a scheme with the sole or dominant purpose of increasing the company's entitlement to the cash flow boost. Now, ultimately, the ATO was successful before the AAT. The tribunal agreed with the ATO's position and found that the steps that were taken towards the end of March by the company and its directors in conjunction with its accountant constituted a scheme to increase entitlement to the cash flow boost. Now, the AAT kind of picked up on a few key things around these directors' fees. The first one was the timing of the payment. Now, this was a company that did often pay directors' fees each year to the directors, but those fees were typically paid right at the end of the financial year as it became apparent what the profit or loss for the company would be for the year. So paying a director's fee in late March was an unusual step and was not consistent with the company's ordinary business practice or its pattern of operations over recent years. The second thing that came up was the amount of the director's fee. The amount paid here, $25,000, was higher than what would be typically paid as a director's fee. Again, we had a break in the established pattern, not just in timing, but also the amount of the director's fee that was paid. The third thing was the amount that was withheld from the payment. Now, the cash flow boost program, you may recall, to some extent is based on the amount that is withheld from things like salary and wages and director's fees. Now, in this case, an amount was withheld from the director's fee. The amount that was withheld was calculated as if that payment related to a single week of work. So you ended up with a very large amount of withholding relative to the amount that was paid to the director. What the AAT said was, well, in a case like this, surely the withholding amount should have been calculated on the basis that this represented a payment for 9 months worth of work by the director, not just 1 week's worth of work. And the AAT also picked up on some inconsistencies in the arguments here. The argument put forward, or part of the argument put forward by the directors of the company, were that there were some cash flow concerns for this company. And the AAT said, well, why would you voluntarily withhold much more than you're actually required to and give that to the ATO if you're concerned about your cash flow position? That didn't really stack up. So putting those things together, in addition to kind of some other things that came up in the course of that case, the AAT said, well, look, we can't see any other reason why this amount of director's fee was paid at this particular time other than to increase the entitlement to the cash flow boost. As a result, it appears that this step, or this series of steps, were taken with the sole or dominant purpose of increasing entitlement to cash flow boost, therefore triggering the integrity rules. Now, as I said earlier, this is one of a number of examples where the ATO has looked at cash flow boost entitlements in detail and has applied or sought to apply the integrity rules. And what we're seeing is that the ATO are having a pretty good run. They're being pretty successful when it comes to these things coming before the tribunal. So the warning is out there, particularly for those entities that changed their normal pattern of behaviour in terms of timing and amounts of payments. These things are being picked up at the moment by the ATO, and we can expect to see more of this. If you or clients have concerns in this area where you think, well, hang on, we might have a bit of an issue here, it's worth having that discussion with them in terms of whether it's appropriate to potentially make voluntary disclosure. They're the sorts of discussions that you may wish to start having with clients where you think that, maybe their fact pattern starts to look a little bit like some of these cases that are being run by the ATO. So the warning is out there. The ATO is looking at this in a fair bit of detail. They are picking up on these situations where there's changes in business practice and where that has led to an increased cash flow boost entitlement. So need to be really careful, and not just for cash flow boosts, but remember, as you're looking at state government grants and things as well, likely that some entities will encounter similar issues and around changes to normal business practice. So it is something to keep in mind, not just in cash flow boost terms, but also beyond that when it comes to other particular government stimulus payments and grant programs.
And that's the tax roundup for this month. There is a lot going on for accountants and advisors still, let alone the COVID-19 relief measures, but everything else in between. If your firm is not a member of Knowledge Shoppers yet, then give the team a call on 1800 800 232. We'd love to show you how we help thousands of accountants across the country every single day. Speak to you soon.